Hello there, my friends. Chris Marcus here with you for Arcadia Economics, and today a quick video about why the yield curve is getting inverted. As you can see here on CNBC, bond yields, especially on the longer end, have been falling quite a bit, while the Fed so far has maintained its Fed funds rate. And here you can see 1 month at 2.36, and then really as you get out to the 2-year, below 2%. 7-year at 1.95%, and the benchmark 10-year at 2.07%. And you may have already heard a lot of folks mention how typically when you have an inverted yield curve, which means yields at the long end are lower than the front end, that it's the market signaling that a recession is on the way. And why could that be? I mean, you have the tail end of bubbles that have been propped up by money printing following the collapse of Lehman Brothers, Bear Stearns, and the mortgage market. Fed came in, printed an insane amount of money. You saw last year, real estate market started to slow down. They tried raising rates, and towards September, October, the stock market was getting pummeled. We started hearing how there might not be any more rate cuts early in 2019, end of quantitative easing. So again, when it's time to unprint the money, the market, just for the exact reasons why if stimulus is supposed to stimulate the market, taking away the stimulus is naturally going to do the exact opposite. And now that's what is happening, because on top of the pressure that is already on some bubbles that are getting kind of wobbly. You know, you have a trade war going on between the US and its largest creditor. And then shockingly enough, apparently now we have a trade war against Mexico, and apparently this afternoon, India is getting involved there. Here you see when President Donald Trump threatened to put tariffs on Mexico, the bond market took it as a sign trade wars could become more random and long-lasting. Certainly, while it's fascinating the volatility you see over the day-to-day announcements of whether U.S. and China are meeting or not, what they're having for lunch, really you've had a year and a half where there's been a lot of headlines and market volatility, although very little change, except it seems like they just keep slapping more tariffs on one another. There was a white paper out of China this weekend that seemed to indicate that, if nothing else, China doesn't plan to back down. Certainly I could understand why, especially given that they are the largest creditor to the U.S. So now we're finding not only could they be long-lasting, but now other countries as well. And certainly the list of countries that the U.S. government doesn't play well with is not necessarily a short one. Wall Street quickly adjusted its outlook on federal interest rate policy and now expects 2 cuts this year as the economy slows down. Wow, who could have seen that coming? Unless you know, you've been paying attention and seeing how the Fed does the same thing time and time again. Whenever it's time to raise interest rates, you know, oh, the economy's not strong. So somehow it's strong. Everything's great. It's strong. But now we're looking at I didn't see if they had market pricing, but I would imagine that the market is pricing in probably 2 rate cuts at this point. Interest rates have fallen rapidly to the point where many in the market believe the benchmark 10-year Treasury yield, which impacts mortgage rates, could fall below 2%. Truly stunning when we're talking about the largest debtor nation in the history of the world, that even a first-grade economic glance at the debt load and the politics would make it pretty clear that not only is it mathematically impossible to ever be repaid, doesn't seem like there's much intention that it's going to be repaid, yet here it is, you're getting a nice 2% interest rate. I mean, that's already the Fed's inflation mandate, so that means you're getting no interest rate according to the Fed numbers. if you stack that up at John Williams of Shadow Stats, who uses the formula before the government changed it, I believe is at around 9 or 10%. So the market's rallying to lock in a negative 8% return. Fascinating times we live in, but here bond market is digging in for periods of low interest rates. This is fascinating. You know, I like to be open to all possibilities, and certainly having a background trading options, looking at things not in absolutes, this is going to happen, this isn't, but you know, maybe there's some extreme, you know, the Fed cutting interest rates a full point tomorrow before, you know, 2 weeks before the meeting. You know, maybe there's a 0.001% chance of that happening. Still different than zero. And one of the things I had been wondering is that shortly before the latest round of trade wars got ratcheted up, you heard Trump talking about wanting a 1% interest rate cut. And certainly if you wanted to stiff arm the Fed into cutting rates, slapping a whole bunch of tariffs would be one way to do it. And the president, who had been pushing for rate cuts, may get his wish after the threat of Mexican tariffs prompted a number of Wall Street economists now forecast 2 interest rate cuts this year after not expecting any before. For what it's worth, I'm sure in one of these videos somewhere, I was talking about it a lot last year, that when they started raising interest rates, they were going to run into trouble. More money printing would be on the way, which seems like is what is happening. JP Morgan's shocking forecast. Bond pros say the yield could easily dip to 2% or below. Would not be surprised. You know, and I guess there's funds piling in, although given the deficits that the US government is running, I have some suspicions about who might actually be buying this debt. Again, Dr. Mark Skidmore found $21 trillion in missing money. Where do these things go? We hear a lot about exchange stabilization fund purchasing treasuries, perhaps, and not telling folks about it. And my guess is that the Fed probably prints and buys a lot more than they actually report either. Here, Mexican tariffs injected a level of uncertainty into the market that will be difficult to repair. I think there's truth to that. So Fed has changed bias to easing. An economic outlook that is more vulnerable. I think the market technicals are more fragile. Rate cuts warranted soon by director at Wells Fargo, and also St. Louis Fed President James Bullard. So whether we actually see that at the June meeting or not, again, it's just interesting to see that maybe we're reaching the point where the market and natural forces are taking back over. I guess that would be temporary anyway, because, you know, my expectation, whether June or later, you will see the Fed cut rates. So who knows what they have planned or what they'll cook up. We heard about maturity extension programs, which sounded a lot like QE to me. Haven't heard anyone in the mainstream media talk about this, but that was in the Fed minutes. So certainly a lot telegraphing that they are going to be cutting rates soon, and the bond yields and different things that are happening there would be one of those signals. So leave any questions below. Fascinating stuff happening. And with that said, thanks for watching. I'll check in with you soon.